Capital gains tax. It's way less talked about than income tax and national insurance, but often just as important. And whilst there isn't a huge amount you can do about the amount of income tax you pay, because there aren't as many reliefs available that you can offset against, there is more available for capital gains tax. There are ways, legitimate ways, that you can minimize your tax bill when the value of your assets goes up. And in this video, I'll talk through 5 of them. But just before delving in, I want to tell you something. 88% of people who watch my videos are not subscribers. To reach more people and to help them in their quest to become better with their money, can I ask you, if you're not already a subscriber, to hit the subscribe button? It would really help me and the channel out. Thanks for doing that. Now back to the video. So here is number 1. Max out your tax-free allowance. Annually, everyone gets a small but valuable capital gains tax allowance. If you make gains up to this amount, then there is nothing for you to pay in tax. After this tax-free allowance, you pay tax depending on what tax bracket you fall into, i.e. basic rate payers pay the basic rate of capital gains tax, and higher rate taxpayers pay a higher rate of capital gains tax. There is a technique called bed and breakfasting, and I have no idea why they call it that. Sounds rather silly to me. But there is a technique that's called that investors often use to avoid losing out on their tax-free allowance at the end of a financial year. If they've made gains in the stock market, for example, in that tax year, then they can use this bed and breakfasting technique to sell their investment at the end of a tax year and then rebuy that same investment at the start of the next tax year, thereby utilizing their tax-free allowance. Now you should know there are specific rules around this and what is allowed and not allowed, but it is still possible for investors to utilize this technique if they were to rebuy using a different vehicle, an ISA for example. This way they have stayed in the stock market in their particular investment, but they've also been able to utilize their capital gains tax-free allowance for that tax year. This does, however, come with some risks. For one, that could be transaction costs that they have to pay on the sale and the rebuy. The market may have also moved against investors in the short time frame between selling and rebuying. Investors may have used their tax-free allowance, but they still may have a capital gains tax bill to pay above this, even though that money has been reinvested in the stock market to buy the exact same stocks in the next financial year. So as you can see, there's more to it than simply executing this technique. But this video is about giving you insights into the methods available. It's not about recommending or advising the pros and cons of each. This will always depend on your personal circumstances, and you should always seek your own independent financial advice. Now number 2. I mentioned an ISA before, and now I'm going to mention them again because number 2 is all about utilizing your tax-free vehicles as much as you can to minimize any capital gains that might be due if you had done otherwise. If you hold any index mutual funds within an ISA like I do, then any growth in these funds, when you sell, could ordinarily trigger a capital gains tax liability. But if you hold this within an ISA wrapper, then that is capital gains tax exempt. So wherever I can, I will invest through my ISA first, and only when I've maxed out my allowance for any financial year will I look to invest outside of that tax-free wrapper. I'm not a fan of pensions, as many of my regular viewers will know from my previous videos. But just so you're aware, they also benefit from no capital gains tax. Though of course you do eventually pay income tax on the amount of your pension that you come to withdraw, and there is no way of knowing what the income tax rates will be at that time, or what new rules governments between now and then could bring in that would impact the amount and the way you draw down from your pension. Now let's move on quickly before I start ranting about pensions again. On to number 3. We talked about you having an annual capital gains tax allowance. Well, it won't surprise you, or at least it shouldn't surprise you, that this allowance isn't unique to you. I'm sure you're unique in all sorts of other ways, but not in this one. Your spouse or civil partner get the same tax-free capital gains tax allowance every year that you do, just like everyone else. But it might surprise you to know that in most cases, transfer of assets between you and your spouse or civil partner are exempt from capital gains tax. So you can bring down your capital gains tax liability by managing your asset gains and potential tax liabilities as a couple. This goes beyond just the use of allowances, as if one of you is on a lower tax bracket or doesn't work, then again, use of this lower bracket can help bring down the amount of capital gains tax that you would otherwise be paying. Number 4, log your losses. Whilst none of us wants to make any losses in any investments we make, we also know that life is full of ups and downs, isn't it? I strive for more ups than downs, of course, like we all should, but downs are inevitable. So when these capital losses do occur, we could benefit by not letting them go to waste. What do I mean by this, you may ask? Make sure you have recorded these losses with HMRC by filling in a tax return, so any gains you make in the future can be offset by these losses, thus further reducing any capital gains tax liability you might have. Now number 5. SEIS and ACE. Okay, so they're not normally called SEIS and ACE. I just thought that was mildly funny. But anyway, they're normally called SEIS or EIS. SEIS is the Seed Enterprise Investment Scheme and EIS is the Enterprise Investment Scheme. These were set up to encourage investment in small companies that don't trade on the stock market. Investors are encouraged to support these companies through tax breaks in the form of income tax relief and capital gains tax relief. This video is CGT related, so we'll focus on that. So there's two things to note here. If you invest in an SEIS or an EIS eligible company and hold for a few years, then you don't pay any capital gains tax on any profits you make. But the lesser known point is point number 2. If you have sold an asset elsewhere, stocks, crypto, property, businesses, you name it, and you made a profit that now leads to a capital gains tax liability, then you can invest this capital gains profit into an SEIS or an EIS eligible company and reduce your capital gains tax bill by up to 50%. This has the added benefit of compounding your gains further and tax efficiently if the companies that you invest in do well. Have you used any of these tips before? Or if you've got any questions, pop them in the comments below as well and I'll do my best to help you if I can. I mentioned crypto just there. If you're confused about the basics and would like to know more in a very simple way, then I've got this video series just for you which you might want to watch next. And finally, if you like videos like this on money and personal finance, then find that big button below that says subscribe and hit it. You'll be glad you did. See you on the next one.